In 2022, the stock market was a minefield. The S&P 500 dropped nearly 19%, the Nasdaq cratered over 30%, bonds, typically a safe haven, offered little protection, tech giants lost hundreds of billions in value. For millions of investors, it was a brutal year, but some weren't just surviving, they were thriving, quietly collecting $100 a day, every day, even during the crash. No day trading, no high-risk gambles, just a methodical income strategy built on a powerful but underutilized financial tool, ETFs. In this video, I'm going to show you exactly how it works. We'll walk through the ETFs, the numbers, the real-life results, even during market crashes, and how you can use this strategy to generate $100 a day in consistent, reliable income. Let's be honest, $100 a day might not sound like a lot to some, but zoom out for a moment. That's $3,000 a month, or $36,500 a year. To put that in perspective, the U.S. Bureau of Labor Statistics reports that median weekly earnings in 2023 were about $1,100, or roughly $57,000 a year before taxes. So, a $100 a day income from investments would be the equivalent of 64% of the average full-time salary. And here's the catch, that $36,500 is passive income. It doesn't require clocking in, answering emails, or managing staff. It arrives whether the market is up or down, if you structure it right. If you live in a high-cost city, $100 a day might cover your utilities, food, and transportation. If you live in a lower-cost region, or abroad, it could pay your full monthly living expenses. That's the power of daily cash flow. It gives you flexibility, stability options, even freedom. But how do you build a portfolio that reliably delivers $100 a day? There are thousands of ETFs in the market, but to create a strategy that pays consistent income, even in a downturn, you only need to understand three types. High-yield income ETFs, covered call ETFs, dividend growth ETFs. Let's break each of these down. These are your heavy hitters. High-yield ETFs like QYLD, RYLD, and XYLD are built to produce income first, growth second. Some of them use covered call strategies on major indexes like the Nasdaq 100, the Russell 2000, or the S&P 500. Take QYLD as an example. In 2023, it offered a dividend yield of roughly 12%. If you held 1,000 shares, you'd have received over $2,000 that year in income, paid monthly. The shares themselves are usually priced modestly, hovering around $17 to $20. This makes them accessible for investors building an income base. However, the trade-off is that these funds don't usually appreciate much over time. That's because they're actively writing covered calls on their entire portfolio, limiting upside potential. But if you're focused on cash flow, not capital gains, these ETFs form the foundation of your $100 per day strategy. While high-yield ETFs are excellent for income, covered call ETFs like JEPI and JEPQ bring something else to the table: stability. JEPI, for example, focuses on low volatility, high-quality stocks, and uses a more conservative covered call strategy. In 2023, it provided an annual yield of about 11%, with significantly lower volatility than the overall market. What's impressive is that during the 2022 bear market, JEPI lost only about 3%, while the S&P 500 fell nearly 19%. That kind of resilience is rare. JEPQ is its tech-focused sibling, targeting Nasdaq-like growth but with the same option overlay structure. It often yields around 10.5% and helps reduce exposure to major tech drawdowns. Then there's NUSI, which takes things a step further by including protective puts, essentially hedging against market drops. It yields a bit lower, around 7%, but is built to weather rough patches better than most. These ETFs don't just protect capital, they keep income flowing even when markets falter. Finally, we have the dividend growth ETFs. These aren't income machines today, but they're your portfolio's long-term health insurance. Funds like SCHD, VIG, and DGRO are built around companies that consistently raise their dividends. SCHD in particular has a strong record around 3.5% annual yield and over 10 years of 11% average dividend growth. It also delivered a 10-year total return close to 12% annually, including both dividends and price growth. In a portfolio focused on generating daily income, these dividend growth ETFs provide durability. They help offset inflation and reduce risk of income stagnation over the long run. So how do we put this all together? To generate $100 a day, or about $36,500 a year, we need a mix of the ETFs mentioned above, allocated strategically. Start by heavily weighting your portfolio toward high-yield ETFs like QYLD and RILD. These provide the bulk of the income, often yielding 12% or more. Add in JEPI and JEPQ to lower volatility and diversify your income sources. Finally, include SCHD for long-term growth and stability. For example, someone might hold 4,000 shares of QYLD, 2,500 shares of JEPI, 1,000 shares of SCHD, 2,000 shares of RILD, and 1,000 shares of JEPQ. Based on average yields and dividend data from 2023, this structure would produce nearly $3,000 per month in income, or just shy of $100 per day. To build a portfolio like this, you'd need approximately $185,000 to $200,000, depending on current ETF prices. But remember, this is just a model. You can scale it to your budget. You might wonder, but does this actually work during a crash? Let's look at two key events. First, the COVID crash in March 2020. The S&P 500 dropped over 30% in a matter of weeks. QYLD fell about 20%, but it continued to pay dividends. SCHD dropped too, but recovered faster than many individual stocks. Meanwhile, funds like NUSI softened the blow by hedging with puts. Second, the 2022 bear market. Inflation soared. The Fed raised interest rates aggressively. Stocks and bonds fell together. The Nasdaq dropped 33%. The S&P 500 fell 19%. Yet JEPI only dropped about 3%. QYLD and RILD held up relatively well and kept pumping out income. SCHD fell moderately but maintained and grew its dividend payout. The takeaway? This strategy isn't bulletproof, but it's built to withstand storms. You may see small dips in income or temporary drawdowns in price, but your monthly payouts keep flowing. No strategy is perfect. Here are the trade-offs and risks to be aware of. High-yield ETFs can suffer from NAV decay over time if prices stagnate. Covered call strategies limit upside during bull markets. Dividends are often taxable, even if reinvested, unless you're in a retirement account. Markets may force distribution cuts in rare extreme scenarios. The key is balance. By combining high-yield income with growth and stability ETFs, you can create a portfolio that not only delivers $100 a day but stays resilient and sustainable. And it gets even better when you reinvest part of that income. Let's say you start with $100,000 and your portfolio yields 10%. That's $10,000 in annual income. Now imagine you reinvest just 40% of that each year while spending the rest. With some modest price appreciation, let's say 3% annually, you can expect your portfolio and income to grow steadily. After 5 years, you're not just collecting income, you're earning more every year without adding new capital. Your portfolio grows, your yield grows, your income becomes more reliable. That's the power of compounding applied to cash flow investing. You don't need $200,000 to get started. If you've got $50,000, you can build a scaled-down version that delivers about $25 a day, or $750 a month, enough to cover groceries or a car payment. With $100,000, you're looking at around $50 a day, halfway to full financial independence. And as you reinvest your dividends and add to your portfolio, the income grows. This isn't about making a quick buck. It's about creating a reliable daily income stream that works whether markets are up, down, or sideways. $100 a day may not make you rich, but it will make you free. It gives you options, whether that's early retirement, paying down debt, or starting a business on your terms, and it all starts with a plan, a few well-chosen ETFs, and the discipline to stick with it, even when the market gets rocky. If this strategy made sense to you, hit the like button. Subscribe to the channel for deeper ETF breakdowns, income updates, and recession-proof investing tips. Have a specific budget? Drop a comment and I'll help model a custom $100 a day ETF plan tailored to your situation. Let's build wealth the smart way, one dividend at a time.